so much for coming and waking up early. Really appreciate you joining. I think I know many of you, but for those I don't know, it's great to meet you. I'm Morgan Krupetsky. I'm the head of institutions and capital markets at Avalanche, where we're really working with the whole spectrum of companies from startups all the way through large regulated buy and sell side institutions as they issue and tokenize assets on Avalanche. So Avalanche's focus and Avalanche's focus, as you heard yesterday, has really been to focus on tokenization from the beginning. The stated mission, included in the stated mission, is really to digitize the world's assets. So it's something that it's been at the forefront of our minds even before the concept kind of regained in popularity at the end of 2 years ago. So to that end, we meet with a lot of teams, from startups to incumbents, and many of those conversations at some point start to feel very similar. There's various and kind of common themes that come up, and with those common themes, a lot of misconceptions and a lot of myths that start to emerge about what is tokenization and what it means. So today we're going to spend some time talking about what are some of those common misconceptions, and then really spend time digging into what we think good looks like, what we look for when we meet with different projects and protocols within the ecosystem, and what we get really excited about when we decide to really kind of strategically lean into working with various partners. So like I mentioned, tokenization is not a new concept. Back in the previous cycle, RWAs were referred to as STO, security token offerings, as some of you guys may recall. But the concept kind of really re-emerged in terms of popularity really 2 years ago. Why is this the case? Why do we think this was the case? And why do we think potentially this time might be different? So 2 years ago, there were really kind of 4 macro factors that coalesced really around the same time. In the first instance, we had more institutional grade infrastructure put in place, whether that's things like compliant tokenization issuance platforms, KYC, AML, and transaction monitoring capabilities, on and off ramps, stablecoins, really the infrastructure to be able to facilitate compliant token issuance as well as trading transfer. In addition, and related to that, we really had the advent of DeFi this time around. And what this showed was that once you tokenize and issue an asset, there's a lot more that you can start to do with that asset. Trade it and transfer it, pledge it as collateral, lend it, really kind of create greater asset utility and mobility once something is tokenized and put on chain. Third, back, and many of you will remember this, we started having rates in the real or the macro world start to go up. And at the same time, this really kind of coincided with the crypto winter. So we saw a big kind of outflow of capital from the off-chain world from the on-chain world back into the off-chain world. And this really kind of put a focus on bringing real yield and real-world assets on-chain. And then, finally, we had Wall Street executive buy-in. And not just buy-in, not just Larry Fink touting the future is tokenization, but really action. Finally, banks, asset managers actually doing things in this space. So whether that was WisdomTree or Franklin Templeton or BlackRock, many various institutions actually started walking the walk. Also, since this time, we saw massive growth in the quintessential RWA, which was stablecoins. There was clear kind of product market fit for stablecoins on chain as a medium of exchange, and really over time we've seen $170 billion in stablecoin market cap created really across various types of stablecoins. So to that end, it's really no wonder that we saw institutions peering over and being excited and thinking, well, all of this stablecoin market cap today really doesn't generate any yield for the end investor, whether that's an individual or an institution. So let's think about potentially offering our products and services to this cohort of individuals and institutions that are on chain today, notably through money market funds, which we would consider cash equivalents, and have some of that cash start bearing yield. And so at this point, literally everyone and their mom are launching money market funds. This is generally, again, really focused on on-chain institutions and crypto natives. And what we've seen here so far is interest in leveraging these money market funds as collateral, backing new and more stablecoins. And there's also been a little bit of product market fit with institutions that already are deploying funds on chain today. And so to the extent that they need to have and hold cash on the sidelines, the idea of being able to put them into money market funds and have those positions generate yield in the meantime, they've been finding attractive. And along with this growth in money market funds and stables, we find that at that point, individuals and teams really start to just hone in on this crypto-native capital and these crypto-native end users. The thought is something like, well, they've deployed capital on chain already, so let's start offering them some private equity or some fractionalized real estate. And we start to hear things like, blockchains are new sources of demand and distribution, that tokenization increases liquidity, and that tokenization increases the inherent value of the asset that is backing. To me, this really starts to conflate the capabilities of the tech as an enabler with the actual business outcome that the project ultimately wants to achieve. So yes, the tech can help to facilitate easier value transfer. It can help to make smaller investment minimums possible. It can even help to achieve greater utility and transparency. But the tech itself cannot make an unattractive off-chain asset more attractive. It doesn't magically come with demand or embedded liquidity, and it doesn't come in with people running to borrow and lend against it, especially in the case of Web3, where oftentimes the UX almost adds more frictions. And so to that end, for projects really looking to ultimately achieve those business outcomes, which I think all of us are, that really requires a lot of time, focus, dedicated attention, education, and serious business development to really kind of start to push the space forward from an adoption standpoint. So instead of dwelling on the myths and misconceptions and the pitfalls, let's focus on what we think good looks like, the approaches and characteristics of RWA projects that cause us to really get excited about strategically leaning into working with projects, and also concrete and actionable examples within the very own Avalanche ecosystem. So first, make sure that you have a clear articulation and understanding of the value prop. To do that, you need to know and identify who your target market is. Is it a bank, an asset manager, a retail user, an accredited investor? Is it a family office? Be able to identify exactly who you're building for and speak to them. Go to TradFi conferences and speak to those people if that's who you're focusing on. Understand how they operate, their pain points, what are their goals, what are their objectives. And having a clear understanding of this target market will then help you to be able to explain why you're building what you're building, how it uses blockchain, and how it therefore improves upon the way that they do things today using Web 2 or traditional Rails. We always suggest to projects, come equipped with a one-pager, a very simple one-pager outlining end-to-end what your target market, how do they process a certain thing today, how do they access a certain asset today, how do they administer it, and side by side, how does your solution compare? And where exactly are the efficiencies and cost savings that you're talking about? Where do they fit into the picture? This is a very powerful tool to have on hand when you talk to prospective clients as well as partners and potential investors. Next, have a compelling asset focus and don't boil the ocean. Unfortunately, a crappy asset is a crappy asset, and tokenizing it isn't going to change that. But can the tech make it easier for an investor to assess and capitalize on potentially a new opportunity? Probably. This is another reason why it's really important to understand and be speaking with your target market as you build. You want to make sure that there's actually a product market fit for the thing that you're building, and have a really good sense in terms of how you stack up against your competitors, not just in the Web 3 space, but in the Web 2 space. And having this feedback will really give you a big leg up. Being able to approach a partner or a potential investor and say, hey, I've spoken with A, B, and C company, and what we're building really aligns with their focus area, or it really solves this pain point or this problem of theirs. And not only that, but they're really excited about either being a launch partner or a potential client when we launch. This is a very powerful thing to be able to say. Third, make sure that you have a strong go-to-market and distribution strategy. While I think it's okay to at first focus on crypto natives, especially depending on the type of asset that you're focusing on, ultimately, the liquidity and the users today are still off-chain. And a perfect example of this is actually Godzilla Games Off the Grid, which I'm sure you're all familiar with. In such a short period of time, the game has attracted millions of users and millions of transactions, and the users are by no means all crypto native. So what's the lesson here? Rather than the team having created a standalone game using a standalone console and bringing users into their environment and teaching them how to use the crypto components of what they've built, they're really meeting gamers where they're at through traditional or existing distribution channels and access points. So that's things like their PCs, their Xboxes, their PlayStations, where the gamers are already at, through the Epic Game Store, where the gamers are already at, and through Twitch, where the gamers are already at. So this is really the third-party integration and distribution channel with existing distribution channels that I think the tokenization space should really start to focus on and really start to strive for. Meet investors where they're at. So think about integrating your offerings with things like RIA platforms, private banks, and traditional distribution channels like Fidelity, Schwab, Interactive Brokers, Robinhood, Revolut. Even when you think about embedded finance, think about integrating your offerings into non-financial applications that are Web2 based, that already have embedded users, and many of which oftentimes are KYC'd already. This is what I think ultimately we should be striving for. Finally, have a thoughtful approach to utility beyond just saying, oh, you can also trade it on a secondary market and you can potentially pledge it as collateral. This is a little lazy. If this is what you're going for, which not everyone is who is focused on tokenization, really make sure that you think about how you're going to operationalize this. How are you addressing liquidity provisioning? How are you addressing regulatory considerations? Which partners are you bringing to the table to actually execute this? And if you don't have those, at least be able to identify what is that MVP level of partners that you need to bring to the table to get this done. This will also help you, again, show that you've done your homework and really be able to explain the how and why blockchain and why tokenization questions. Now, there's definitely not a one-size-fits-all solution, but really make sure that you do your research and really avoid the pitfall, therefore, of building a solution in search of a problem. So let's go through some concrete examples within the Avalanche ecosystem. Now, Agora. Agora has built a fully collateralized US digital dollar called AUSD. Agora's founder came to us with a very clear and unique business model. The company incentivizes businesses to contribute to and service the AUSD network by onboarding them and allowing them to participate in the economic upside of the growth and adoption of the network. This was a key differentiator that they brought versus the competitive stablecoin landscape, and something that many protocols we found are really interested in onboarding with, not only within the Avalanche ecosystem, but really across various blockchain ecosystems. In addition, the team came to us with existing partnerships that they brought to the table, including liquidity providers, exchanges, DeFi funds, as well as various payment companies that were committed to using AUSD. And looking ahead, the team has ambitions to really work with global fintech companies to serve as the back-end plumbing in terms of their payment capabilities. After just 2 months of launching, Agora has onboarded 50 businesses and has done $750 million in cumulative transfer volume to date and is doing $10 million in daily sales volume already. Now let's turn to Dinari, which is a company that's tokenizing public equities. They use a B2B2C approach where they really onboard and focus on companies like startups and neobanks. So they're first targeting, let's say, emerging market-based neobanks and allowing their customers in turn to access US equities. Those end users don't care and in many times don't even know that they're using blockchain and tokenization tech, but that now they have access to US equities. So this is really where the Web3 abstraction component is key here. Looking ahead, Dinari has plans to launch additional products and services that offer capabilities that really aren't possible through today's Web2 brokerage accounts. So think about things like being able to swap one equity position for another, and also being able to potentially LP some of your long-term equity positions and start to earn passive income on those things. Since launching earlier this year, Dinari has onboarded nearly 30 partners with a cumulative 3.8 million end users. And then last, we have Inan. Inan was actually Avalanche's first ever institutionally focused L1 that launched in February of 2023. Their platform basically makes it easy for institutions and service providers to manage asset-backed securities, which are effectively pools of underlying loans. The team has been at this for quite some time now, and they're at this point clear about the efficiencies and cost savings that they bring to the table and have a very good sense of how they compare with their Web2 competitors, which are frequently used in the space today. Some of these things include the ability to provide real-time loan reporting via their Web3 platform versus the way that the system works today, which is via PDF on a 30-day delay. They also have a really great sense of how their platform stacks up against their Web3 competitors. And at this point, they work with several large TradFi customers who are already onboarded and actively using their solution. So here's a sampling of the RWA landscape within Avalanche. I'm sure I'm missing some. But overall, at the asset layer, we have many issuers issuing and tokenizing assets really across the liquidity spectrum, the duration spectrum, the risk spectrum, everything from cash and cash equivalents all the way through private market assets and funds to culturally relevant assets and really everything in between. Then we have the infrastructure layer where these partners are critical to the compliant security token issuance, trading, collateral mobility, custody, and so on. And then obviously you have Avalanche as the underlying transaction and settlement layer. Several of these partners are speaking on various panels this week. They're doing showcases, and even more are here this week ready and willing to chat. So I would highly suggest seeking them out, having conversations, explaining what you're building, understanding what they're building, challenge them, and ask difficult questions, because I think together we're really kind of pushing this space forward, really driving the future of finance together, really growing the pie together. Personally, I'm very excited to be doing this with all of you guys from an Avalanche community standpoint. If you guys have any questions, feel free to find me throughout the rest of the session, and thanks for listening.